Hey guys, in this video we're going to be talking about investment funds and two of the most common types of investment funds for individual investors like you and me. One of the most important rules of investing and in life in general is do not put all your eggs in one basket. The way you protect against this is by diversifying your investments, and putting some of your money into investment funds is a great first step that you can take to achieve diversification. Here's why. Investment funds are simply pooled investments that are professionally managed using combined capital from many investors. Investment companies and investment fund managers do all the hard work and research to make investment decisions on your behalf. They invest in different types of securities, like stocks and bonds, and then combine all these diversified investments into one single packaged product that investors can consume. Some funds even invest in assets like real estate, commodities, or precious metals. Investment companies and fund managers also have strategies and objectives for the fund. This is called the investing style. One example of an investing style is growth funds, where managers invest in companies that are likely to experience great capital appreciation. You can also have index funds, which simply replicate a market index that measures the performance of a group of stocks and invests in all companies that form part of that index. For example, if you invest in a S&P 500 index fund, which tracks the performance of 500 of the largest US companies, then your money gets invested in the same proportion in all 500 companies tracked by that index. Funds can be actively or passively managed. In actively managed funds, the fund manager is actively making investment decisions with the expectation of beating the market, which means getting better returns than the average performance of the market or a large portion of the market, like the S&P 500 index. But the risk of trying to beat the market is that in some cases you can end up underperforming the market. On the other hand, one example of passively managed funds are index funds, because they simply automatically track a particular index with the expectation of getting the same returns as the index. And as you can guess, management fees are a lot higher for actively managed funds, while maintenance costs are much lower for passive funds. There is a document called the prospectus, which explains in detail the characteristics of the fund, like the objectives and strategies, the management fees and costs, the risks, the historic performance, and many other things. You should always read the prospectus before selecting your fund. Okay, great. Now that we know what funds are, what exactly happens when we buy a fund? What are we exactly buying? It turns out that investment funds actually issue or create shares that represent a portion of the fund. Then, when you invest in a fund, you're actually buying shares from the fund that represent a portion of the underlying securities and assets held by the fund. Having said that, there is an important concept to understand, which is the net asset value, or NAV. The net asset value represents the securities or assets held by the fund. Imagine that I am the fund manager for a fund called the ABC fund. And I, as the investment manager, I buy 10 shares of company A at $10 a share. Then I buy 10 shares of company B at $20 a share. And lastly, I buy 10 shares from company C at $30 a share. If we do the math, the total net asset value for the ABC fund would be $600. You can divide the total net asset value by the outstanding number of shares of the fund and obtain the per share net asset value, or per share NAV. So let's say that I issue 100 shares for my fund that I'm willing to sell to investors, then the per share NAV for the ABC fund would be around $6. Cool, so now we understand how funds work in general. Let's now talk about mutual funds. Mutual funds can be classified into two types, open-end and closed-end. Open-end funds are characterized by being open in terms of their number of shares. If investors buy more shares or new investors join in on the fund, then new shares are created. But if existing investors redeem their shares, they get their money back and their shares get effectively destroyed. When buying shares, investors have to buy them directly from the fund or through a broker. Open-end mutual fund shares do not trade on the open market. And because of this open-end nature, the share price always reflects very closely the net asset value, very similar to the example on the ABC fund. And lastly, open-end mutual fund shares are priced once a day. Closed-end mutual funds are the opposite of open-end mutual funds. Their number of shares is actually fixed, and these shares actually trade on the open market on an exchange. You can buy these shares or sell these shares to investors, just like shares from public companies. But what this means is that now the share price can actually trade at a premium or at a discount of the net asset value, since now these shares are subject to general market conditions and trading activity. Alright, now that we've discussed mutual funds, let's talk about ETFs, or exchange traded funds. As the name implies, exchange traded funds actually trade on an exchange, similar to closed-end mutual funds. But similar to open-end funds, the ETF share price is actually tied very closely with the underlying net asset value. This is because most ETFs are passively managed, since they track a market index. However, ETF prices can fluctuate throughout the day as a reflection of the price movement of the underlying securities. Unlike mutual funds that are priced once a day, there are over 7,600 ETFs on the market. They are super popular due to their flexibility, accessibility, and very low fees. There are ETFs that allow you to track almost any index, sector, or geography. Some of the largest and most well-established companies that offer ETFs and mutual funds globally are the likes of Fidelity, Vanguard, and BlackRock. However, there are literally hundreds and hundreds of investment fund companies that you can find depending on where you live. There you have it, guys. Please don't forget to like and subscribe if you found this video informative and useful. In future videos, we're going to be covering these concepts in more detail. Thanks for watching.